Hello and assalamu alaikum, everyone. Today we have to continue with our first topic for the section, in which in our last class we were studying materiality. We were discussing materiality. Materiality, basically, we were looking at the areas when a person or an auditor has to check which line is to be maintained and crossed. Okay, we discussed some of the areas that included your performance materiality, your specific materiality, and your planning materiality. Planning materiality is done by planning level. Performance materiality is basically the level in which we are working in organization. Now, I will try to give you an example. Now, I'm repeating this topic again because this is a significant topic that will have a problematic effect on your audit opinion or in the complete syllabus if you're not very vigilant about it. Now, if you're talking about materiality, materiality basically is the level of risk you can accept, the level of problems that you are saying that these problems are not our problem, not a matter. Materiality is an amount, is known as material only when it affects the economic decision making of a user of the financial statements. Now, if we talk about how is planning materiality and performance materiality different and how can we apply it, have you ever traveled somewhere? Let's say my house to the airport. Now, my house to the airport normally takes 20 minutes at max. Okay. According to my planning, I will be estimating that 20 is the benchmark. 20 is the line at which I am okay. I can accept the duration of 20, or even I can keep a gap of 10 minutes, let's say 30 minutes. 30 minutes is the amount that is acceptable by me. It will not change my decision making. Okay. Now, if we are talking about a road, so economic cannot be affected here. But just give you an example, if I see that 30 minutes is the time that I can accept on this particular travel of this distance, this is my acceptability level. That is known as materiality. Now, when I start the drive, I see there is an accident on the road. There is a heavy traffic on the road. Will I have a negative effect there? Will I see that this amount in excess of 30, any amount excess of 30 will change my decision making? Yes. Yes, it will. So the materiality is basically the amount, materiality is basically that I have expected something, I have set a line that this is acceptable. Anything that is not acceptable, at what extent it is not acceptable, is to be looked upon. Now, normally what happens is in an audit, when you are assessing something, you are planning something, you have not started the work yet. When you start the work, you see that the risk is very high, and the wrong amounts are in small figures. Let's say, and if I want to commit a fraud, what will be the best way? If you want to detect or correct a fraud, think how would you do a fraud? If I would have wanted to do a fraud, I would have done it in immaterial transactions. I would have taken small transactions, even hundreds of them, because they're not going to be detected or checked by the auditor because they're immaterial. For this, the auditor is also a very professional person. He has a professional judgment and skill. So what he does is, during the audit, he sets a new line. He says that I am seeing that there are multiple transactions and can be risky. So I will now reduce the materiality level and I will check all the transactions that are below the line, above the red line, sorry, below the black line and above the red line. So he has set a new materiality level lower than the benchmark, the planning materiality level, that is known as performance materiality level. At this area, he will be checking all the transactions that are coming above the red line. So is my fraud detected here? Did my techniques work? No, they didn't. Next comes the third area, that is specific materiality level. In some transactions, I have made specialized data transactions. I have made specialized data transaction, but the nature of the transaction is very risky. That will include a loan to the director, a friend taking my car for a drive. Now the amount is immaterial. The amount is very small, but the nature is very difficult. So what the auditor does is, for those transactions he sets a separate materiality level. That I will check this transaction at another level. If they are crossing this line, they will be called material. So all the frauds that are thought by the management can be countered this way. Now, quantitative is basically by amount. So though both of these can be classified as quantitative. But when mainly we are talking about our specific materiality, qualitative is the main area that we focus on. It's not like that only qualitative is focused on specific materiality. Both of them are applied on both the areas, but more when you see a qualitative materiality level, it is specific materiality based on the quality. So after that, I have created a table for you for revision. And next we are seeing expectation gaps. What is expectation gap? Expectation gap is basically what do you expect the auditor to do and what he originally does it. So you expect the auditor to do certain activities, but he does something else. Now, what is that he does? It is a difference between what the people expect the auditor to do and what auditors are actually doing. The common misconception that people have, the auditor tests all transactions. No, they do not. They do not. Why do they not? Now, tell me one thing. I've given this example earlier on, but I will give it again and repeat it. That if there are 100 cupcakes on the table and you want to check whether they are made perfectly or not, or correctly or not, what will you do? You will eat the entire 100 cupcakes? Yes. Or you will take a small portion of the cupcakes. You will take one cupcake from here, one from here, one from here. You will eat 2 to 3 cupcakes and form an opinion that yes, everything is on point or correct. Every cupcake from the start to the last, whenever it was baked, it's on point. Will you do this or eat the complete whole set of cupcakes? You will do this. This is known as sampling. So sampling is a technique through which the auditor works. He is not checking all the transactions. That is a very misconception that people have. Then the auditor will detect all frauds. Now, fraud and detection of fraud and prevention of fraud is basically responsibility of the management. The auditor is not responsible for detecting or setting controls to prevent fraud. The auditor is not responsible. The management is responsible. The auditor will only go through the financial statements. The responsibility is the financial statements. The financial statements are made by the management. So the auditor has the responsibility to check the financial statements and anything that comes in his way in checking the financial statements, whether it be fraud, whether it is a misstatement, an error, whatever it is the area where he will focus on. But it is not a guarantee that he will detect every kind of fraud because he is not responsible for it. He is responsible for the financial statements. Anything that is affecting the financial statements will be in material transaction. And if it is material transaction, material level, he will be checking it. So that is another misconception. Another is that the auditors are responsible for preparing the financial statements. Now you might be thinking that auditor is a certified person. He is a chartered accountant. He is having the relevant experience as well. He should meet the accounts, so there will be no errors. Now I'll try to counter this with an example. If you're saying the auditor should make the financial statements, you have double exam. Okay. You attempted the exam and I tell you that please check your exam yourself. This is the marking scheme, please check it. Now, while checking it, will you identify any errors? If you have still now made 50 mistakes, 50 marks of mistakes. Now, if you make one more mistake, if you identify one more mistake, you will fail. Will you identify any problems, any mistakes? No. In your mind, you will keep the calculation that we should not go near 50 marks worth of mistakes. We should keep it within 40 or within 45 at max, not near 50. So, same is the problem with the auditor. If the auditor is making the financial statements, will he make an honest, unbiased assessment of it? No, he won't. He will be looking at that whatever error he has made, he will try to conceal them or hide them. So he will not be the person correct to check the financial statements. A checker should be independent. A checker should be separate from the one who is preparing it. So the preparation duty is with the management and the checking duty is with the auditor. So these two people should be kept extremely separate. They should not be in connection with each other. So these are the common misconceptions that we have. I have tried to rectify them. These are the most common ones, but there are some other as well. So as we are going with the course, we will be covering them as well. The benefits of audit: improves credibility and reliability on financial statements. Anything checked by an independent person is increasing the reliability of the particular documentation, detects and deters fraud, error, and management bias. Now, you might be saying that just now you told me the auditor is not responsible for detection of fraud. Anything that is hindering the fraud, hindering the financial statements will be in the domain of the auditor. So he will be checking only the areas where he has a risk of misstatement or error in the financial statements. It can include fraud as well, but it will not specifically. He will not specifically go towards the testing of frauds. It is not his job. Now, helps management through independent feedback. Helps management through independent feedback. If the financial statements are checked and they identify a mistake, the management can improve the mistake next time. May highlight weaknesses in internal controls. Internal controls are internal safeguards, internal procedures that a management set so that they can prevent, detect fraud or errors. So if there is a weakness in it, the auditor will highlight it and give a communication to the management or those charged with governance. Enhances reputation and transparency with regulatory investors. If you are getting audit, your investors will be happy, your regulatory bodies will be happy that you are getting your financial statements checked. That means you are honest people, you are on point. Okay. Now some limitations. That they only provide reasonable assurance, not a guarantee. So guarantee cannot be provided. Only a reasonable assurance can be provided, saying that there can be some other misstatements that have not been checked by us. There is 80% chance everything is correct, but still a 20% chance that some misstatement might be there or fraud can be there. So this is a setback. It relies on sampling, not all transactions. So not all transactions can't be tested, not humanly possible for a person. It will take a lot of money and a lot of resources and a lot of time as well. So it is not possible. So this is limitation of audit. Financial statements involve subjective estimates and management judgment. Judgment is fluctuating. It is subjective. So we might miss it out. We might think it is correct, but some or another auditor who might check it might say that this is incorrect. Evidence is often persuasive, not conclusive. What does this mean? This means that if you're forming an opinion, a judge forms an opinion where he gets persuaded by the evidence that the other party is the offender or not the offender. So here also the auditor, when satisfied, when in his professional judgment, he sees that this evidence is enough to convince me that the auditor has the appropriate knowledge that the fraud has been committed or not, he stops there. He is not concluding it. He is not 100% sure that this is done or not, because 100% things cannot be done. If we are checking things 100%, then it is a guarantee. We are not giving a guarantee. We are giving a reasonable assurance. So the auditor, when satisfied, when persuaded by the 80% evidences that he has obtained, he will stop there and move on to the next particular area. He will not go beyond it and collect the 20% evidence left to get a guarantee of everything is correct or not. Then we have sorry, auditor depends on management representations in certain areas. Management representation is basically a document that the management is saying this is happening in this area and we think that is correct. When the auditor has no other option to get evidence, he takes a written document saying the management will write it for us and tell us that this is the thing that is happening and it is correct or not. Okay. So this is the complete areas. Now let's get an overview of review engagement. What is a review engagement? Review engagement is basically a half-yearly engagement. A half-yearly engagement conducted by the auditor where the financial statements of the year end are not yet completed, but in the year where we are giving a limited level of assurance, we are checking the financial statements and we will be telling the authorized party or the stakeholders or the shareholders that nothing has come to our attention that is problematic here or that can be told to be as a financial statements misstatement of fraud. Here we are just giving a normal level of assurance. We're just checking the financial statements casually, so that at the year end, if we are getting a statutory audit, there should be no big significant errors kept in the financial statements that is going to give them a adverse or wrong opinion or a negative opinion. So in a review engagement is basically a limited assurance engagement where practitioners evaluate the financial statements and determine whether they are prepared in accordance with applicable financial reporting framework without conducting a full audit. So we are not conducting a full audit. We are doing a half audit or a review engagement in which we have to check whether the financial statements have the tendency to be made according to the financial reporting framework, that is IFRS. If there are any potential big frauds or big errors that have come to our attention now, in the year end, when the amounts are going to increase, it will be in the attention of the final auditor as well. So if we prevent it now, if we detect it now, if we take measures to mitigate them now, it will be better. In the year end, we will be able to get a better position of a financial statements. This is the main concept of review that is conducted by the audit engagements firms and requested by the management. It is not a statutory requirement. It is an optional thing that people want to do. This is done so that in the year end, if there is in the mid-year, if there is a significant issue, it can be resolved before the statutory audit where the obligatory audit is committed. Okay. So it is performed in accordance with IS RE 2400 engagement to review historical financial statements. The purpose of a review engagement is basically to provide limited assurance that the financial statements are free from material misstatement. It is expressed in a negative form. The form is negative, where he says nothing has come to our attention that causes us to believe that the financial statements are not prepared in all material respects in accordance with the applicable financial reporting framework. So this is the model statement that you will see in the review engagement. Okay. So what is done in a review engagement? In a review engagement, we perform analytical procedures. Analytical procedure is basically logic test. Seeing every transaction, every movement, every activity, and thinking whether it makes sense logically or not. Now, logically means by the accounting standards, by the professional experience, the judgment, the skepticism level, everything combined, does it comply with the financial reporting framework or the previous years or the industry, etc., etc. Let's say if the last year we had a profit of 100,000, this year we are making a profit of 100 million. Is it a significant change? Yes, it is. Is it logical? No. Then we will inspect that there is some problem with us. So in a review engagement, we are doing what? Analytical procedures. Comparing current period with prior periods and budgets. See any significant changes. Ratio analysis to identify unusual trends and inconsistencies that are going to give us a red flag. Analyze the relationship between financial and non-financial data. Financial and non-financial data means that the management is telling us that their efficiency has increased. If their efficiency has increased, the cost of production or the cost of goods sold should decrease as the costs are being reduced. So the cost of goods sold is increasing with the sales being constant. There is no change in sales, but the cost of goods sold increase, indicating that our efficiency is not present. So financial data is not corroborating or being in line with the non-financial data. So analytically, it is not making sense. So it is not logical. We will be asking the management or telling them to change or rectify the particular non-financial statement that we have given. Inquire with the management, asking about accounting policy practices, developing the basic understanding of what they're doing, understanding the business and industry developments, what the industry is about, how the industry is working, what is our domain and what is their domain, etc., etc. What are the significant differences between us? Discussing unusual transaction variances. Any unusual transaction that we found in an analytical procedure can be discussed with the management. Okay. Obtaining written representation. Management confirms that all the disclosures have been in the relevant domains of all factual events and conditions that are present. So management giving in writing everything that is given that is happening in the organization is written and in front of you. Okay. Then we have documentation evidence. All findings and conclusions are documented, even though procedures are limited. Even though we are working at a limited level, we are recording everything so that when the reviewer is there, when the statutory audit is there, and we have conducted a review, we can see that in the mid-air there was a problem with a specific purchase transaction. Have they resolved it? Have they eliminated the risk that was present in the mid-air checking? So this documentation helps you a lot. Next is what is not done in review engagement. No detailed testing, no substantive procedure in statutory audit, such as inspecting invoices, banking information, or physical inventory counts. Nothing is done in detail. No test of controls. Internal control systems are not tested until that point. No third-party confirmation. These are very significant key areas that we do in the statutory audit, and that is a very important area that we are going to learn in upcoming sections. In section of substantive. We are going to see all those areas that are done in the statutory audit, but in review engagement, nothing is done. No audit opinion is given. We only give an opinion on our review. The audit does not state that the financial statements give a true and fair picture. He says that nothing has come to our attention that is a problematic area for that the materials financial statements are materially misstated. We have no view of the financial statement as materially misstated. We are not aware of any. If we work more, then there can be some problems. Common myths about review engagement. A review provides same level of assurance as audit? No, it does not. Review is limited work, so limited assurance. Statutory audit is substantial work, extensive work, so reasonable assurance. A review provides limited assurance, while audit provides reasonable assurance. Myth is review engagement will detect all frauds and errors. No, it will not. Review engagement is limited work, so only significant anomalies, significant changes, significant amounts, or significant frauds can be detected. That's the obvious ones only, not the hidden ones. Hidden ones are detected or corrected when they are done by the management or in the statutory audit. So only significant obvious anomalies can be identified. Hidden frauds or small errors may go undetected because we are not testing anything in detail. The practitioner checks every balancing transaction. No, he does not. He even doesn't check it in the statutory audit. How will check in the review? We are saying that the work is done at a limited level, so he will not be checking it. Review engagement are usually analytical review and inquiry, not transaction level testing. The myth is the review engagement guarantees financial statements are accurate. No, they are not. Guarantee can't provide it in reasonable level of assurance in a statutory audit. How will he provide it in a review? So that is a complete wrong statement. So reality is engagement concludes only that nothing came to the practitioner's attention to suggest material mistake. He's just concluding that nothing is so significant that it can be categorized in our material misstatement category and based on the work that we have done. If you would have done more work, it could have increased or the changes could have been there. So some basic key areas. Level of assurance, semi-limited. Opinion style, negative assurance. Testing performed, no. Testing controls, not performed. Evidence gathering, inquiry analytical procedures, suitable for non-listed small, medium-sized entities or even large entities with who are optionally opting for a review so that their final end transactions or financial statements are not creating or having a significant error. And cost and time, lower cost than audit and lower time required as lower work has been done. So this was all from review engagement and some expectation gaps and myths that we discussed. So we'll keep it in here. In our next lecture, we are going to start with our audit opinions. What are audit opinions? What types of audit opinions are given, etc., etc. Basically, mainly focusing on our statutory audit. So review engagement, concluding and summing up, is basically an interim testing, a half-yearly testing done by the auditor so that he can see that if a prominent fraud is there, it could be detected and communicated to those charged with governance or the management so that they can rectify it, address it, eliminate it till the year end is there and the statutory audit commences. So we'll keep it in here. That's all from my side. Enjoy learning.